How does the CPI affect the stock market? The CPI is the Consumer Price Index, which measures the consumer rate of inflation. The CPI in itself may not affect the stock market, but the reaction of investors and institutions like the Federal Reserve do. The average annual rate of inflation is around 3%, but this past year we saw inflation hit upwards of 9%. This means consumers are paying far more for goods this year than they were last year, and economic growth may not be sustainable. An investor's number one criteria when searching for investment opportunities is, will my return outpace inflation and at what risk? The sole purpose of money is to buy goods and services, and we invest money so that we can grow our future ability to consume. If you're currently in an investment that earns 3% and inflation is at 4%, even though you're increasing your dollar amount by 3%, the net value and future purchasing power is 1% less than it is today. This causes investors to demand higher rates of return to outpace inflation, and we primarily see this in the treasury market. Since US treasuries are seen as the safest investments in the world, the interest rates tied to them are known as the risk free rate. When the demand for higher rates increase, the future rates increase, and investors will start to assess the opportunity cost of putting their money in a lower guaranteed return or leaving it in a riskier stock market. As the risk free rate increases, investors will pull money out of the stock market and put into treasuries, causing more money to leave equities than is flowing into them. This causes the overall stock market value to decline. However, as inflation rates start to lower, interest rates will start to decline, increasing the value of the fixed income securities, which is good for current bondholders, but will reduce new investments into the risk free rate market, and money will be redirected back into the stock market once again as investors weigh future risk reward on their investments.